Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson, Big Al. Thanks for tuning in. Hour 2 coming at you here. Well, it's that time again, Clopine.
You got some more email questions for me?
Now,
Our listeners are starting to really enjoy this segment.
it's getting out of control because I'm getting so many email questions here. Now, NerdWallet.
Yeah?
Heard of them?
Yes.
You've heard of NerdWallet.
I have.
You
I've
have?
seen some articles of theirs.
Huh. Well, now they're emailing me.
Okay.
Hey, I got some questions.
They listen to the show?
I heard you answer questions for Investopedia.
Yeah.
What about us?
What about, let's come on, equal time.
Come on here. So, I don't know. We'll bust through a couple of these. And then a lot of you are emailing us for questions, and you can do that at purefinancial.com. You can go to info or just email info at purefinancial.com.
Yeah.
Or you can just go directly to me or Al. And we will respond.
Yeah, man, you're right on. You usually respond within an hour or two.
Well, it takes me a half a second to respond.
You're like sitting by your computer.
I'm just waiting. That's what I do all day long.
Someone send me an email.
Someone send me an email that I can at least feel productive for a minute. Yep, that's my day.
Yeah.
Sit there, wait for those emails to come in.
Good day. I got one today.
All right. So here you go, Clopine.
Okay, what do you got for me?
So here's an email. Does the early withdrawal penalty on my IRA apply to me? So here's the question. If I choose to withdraw the 10% tax from the amount I withdraw from my traditional IRA, does that also then incur the early withdrawal penalty on top of that amount? If the amount withdrawn is $1,000, should I put aside $200 for the end of the year tax purpose wise?
Okay, well let's kind of back up here.
So these questions.
Well,
What's he doing? If
well-
I choose to withdraw the 10% tax from the amount I withdraw from my traditional IRA, does that also then incur the early withdrawal? Oh, so what he's saying is that he's taking money out of his IRA.
Yes, and then he's going to take
And then he's got the 10% penalty. And so he's going to take it out of his IRA to pay the 10% penalty.
Yeah. So the way I hear that, he's going to take $1,000 out. He's going to take another $100 out to pay for the penalty. So now it's $1,100, right? So now there's a penalty on the $1,100 of 10%. So that's $110. So yeah, it's a penalty on penalty, and you got to pay income tax on that too, depending upon your bracket. I mean, let's just say you're in the 15% bracket. Now you've got about $155 in federal tax, right? So just doing this, so now you got $265. Then you got state tax. So you better pull out some more from your IRA, right? And now you got to pay taxes and penalty on that. And I'll tell you what, Joe, for folks, and that's at 15%, a lot of people are in the 25% bracket or higher. And when you're in those brackets, by the time you add up your federal tax, your state tax, your federal penalty, your state penalty, it's about 50% is your tax.
So here's what usually happens, and this is where people get so confused. I'm going to take money out of my 401k plan, and then they'll withhold 20%. And we talked about this a couple of weeks ago.
Yeah.
Like, they're just withholding it so the IRS will get their money. But you don't pay the tax until April next year when you do your tax form. That's when the penalties will show up, and then that will tell you what the total tax is.
Yes.
And if the 20% was not withheld or was not enough to be withheld to pay that tax, guess what? You're going to owe additional tax.
Yeah, that's just...
And then if you go to your IRA or you're back to your 401k to pay the additional tax because you didn't withhold enough, well, yeah, then that's another distribution. Then you're going to pay tax and penalties on that. And then guess what? Next year, you're going to do the same damn thing.
It just keeps going and going and going. Yeah, no, that's not a good idea. And it's because of that we tell you, really, never use your IRA for anything other than retirement. That's what it's for. Easier said than done, though. I get it. Life gets in the way. But just not a good idea. Very, very expensive to pull money out of your IRA before 59 and a half.
You should just pretend you don't even have it.
You should. Agreed.
Right?
Yeah.
I don't have it. I can't touch it.
Yeah. Right. It's not there.
It's not
Don't
there.
know where it is.
I don't know. Yeah. You got to bury it. Some people just got to hide it from them.
Right, and then have someone else bury it and then they know where it is
with the treasure map.
Of course, they may not tell you later.
Right. All right. Do 401k contributions have any effect on my MAGI, modified adjusted gross income? All right.
Okay. Well, the
answer is yes.
Yes.
All right. Let's hear the question.
Is it deeper than that?
All right. I am close to reaching the IRS income limit for being able to contribute to a Roth IRA.
Okay.
Married finally jointly, $193,000. Okay, well, wait a minute here. Well, we can fix that too. Will contributing more to my 401k lower my income, allowing me to continue funding my Roth IRA?
Okay. Yeah, the answer is yes. That's actually a really good strategy. So I guess if you're married, right now the limit is $184,000 to $194,000.
Right. So he's saying, hey, can I contribute? So it's a phase out. Mm-hmm. So that's another mistake. Once you reach, it's like, all right, if I'm at $193,000 and the phase out's $194,000, is that the end of the phase out? Well, that means you're 90 some odd percent of the phase out, so you could only put in maybe 10% of the allowable contribution.
Yeah, that's right, which if you're over 50, it would be $650. Yeah, so that's the way that phase out works. So right now, if your modified adjusted gross income is less than $184,000, if you're married, you can do a full $6,500 Roth contribution.
If you're over 50.
If you're over 50. $5,500 if you're under 50, correct. And so can your spouse, by the way, working or not. So that can work. Now, let's say you're at $200,000 of income. I'm going to skip the modified adjustment. Just $200,000 of income.
Okay.
Let's say you do, and you're under 50, you put $18,000 into your 401k. So now your income is $182,000. Well, you're below now the $184,000, so you can do the full $5,500 into that Roth contribution, or $6,500 if you're over 50.
Yeah. So contributing to the 401k plan will reduce your taxable income, hence reduce your modified adjusted gross income, or AGI, or whatever else income number you want to look at.
Yeah, and that's important for doing Roth contributions. It's also important for other things, because at certain income levels, your modified adjusted gross income determines how much of your exemptions are phased out, how much of your itemized deductions are phased out, whether you have to pay that Medicare surtax on unearned income like interest, dividends, capital gains. So there's a lot of things. So when you can reduce your modified adjusted gross income,
that's an above the line deduction.
Correct.
So then it's like, okay, well, what's an above the line deduction?
Those are good.
Those are good deductions. Retirement accounts would be above the line. What else could someone do above the line?
To reduce their modified adjusted gross income. Well, if you had if you had a business that lost money,
so
or
NOL,
if you net operating loss, if you have capital losses, you can then carry $3,000.
Health insurance.
Yeah, health insurance if you're self-employed. Other kinds of pension plans if you're self-employed. Yeah, so there's quite a few things.
Most of them are below the line, such as your Schedule A,
such
as state tax and mortgage interest and charitable deductions and medical expenses.
And of course, there's exceptions to what I'm going to tell you, but you might think of above the line as things related to income and direct expenses to that income, whereas below the line is generally personal expenses, right? So it's charity, it's state taxes, it's medical, it's your home mortgage, it's things like that.
I mean, seriously, there's so many questions when it comes to retirement accounts, what you can do, what strategies are appropriate for you. I mean, if you could just imagine a retirement game plan, that you had all the answers. You had everything, to a rock-solid game plan that covered everything from A to Z. I mean, that would bring a lot of confidence.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. Joe Anderson here, Big Al Clopine. Thanks for tuning in. Go to purefinancial.com to get a little bit more information about us if you'd like. We're a fee-only registered investment advisor. We act as a fiduciary 100% of the time. We do not sell any products. We give advice. And so Big Al and I have been given advice, or nuggets, if you will. Don't take this as advice. We don't know you, right? We don't know your situation, so this is not advice. come in and our clients we give advice to.
Yeah, that's true. And that's an important distinction, Joe. I mean, so we're throwing out different ideas, different strategies, trying to educate you on what you need to do to get ready for retirement, or if you're in retirement, how to retire, how to stay retired successfully, tax strategies. But what's interesting, Joe, is what may work for you may be completely different than what your friend and neighbor should be doing, because it's individualized. And the reason is because you have different goals. You may have different longevity in your life. You've got maybe different savings and all kinds of factors that go into what's going to be the best strategy for you. And that's why, I mean, honestly, I know there's retirement income calculators and things like that, and those are better than nothing. But I think a lot of people sort of get misled when they sort of put in 2 or 3 or 4 input variables and then think that they've got this figured out, because there's a lot more to this than meets the eye. And that's why we've been talking about this for 10 years on the radio.
So, and then just to prove just little things when it comes to the questions and emails that we get. And so we're answering some emails from Investopedia.
We switched to them now, not NerdWallet?
I haven't got to NerdWallet.
Oh, I thought you were on NerdWallet.
No,
Okay.
This is Investopedia still.
Okay.
All right.
Okay, cool.
Here's another question for you, Big Al.
Okay.
Which should I take, a monthly pension or a lump sum buyout? I'm single, 68-year-old male. I have a pension, 401k, and have not filed for Social Security yet.
Okay.
I have one 32-year-old son who is living with me. He is not a college graduate and has a low-paying job with no retirement accounts. Should I consider him in my decision?
Ah, interesting. Okay. So that's the end?
So, yeah, can't wait to hear your answer in this.
So tell me the last sentence. The 32-year-old son, what was the fact about him?
Should I consider him in my decision? I'm taking a lump sum or a pension.
I know, but there's something before that. What was the sentence before that?
I don't know. But he's not a college graduate.
Oh, that was the caveat.
And has a low-paying job.
Okay, got it. Okay.
And no retirement accounts.
Okay. Well, I'm going to give you my answer, Joe, and then you can correct it. So here's what I think when you've got the opportunity for pension or lump sum is, first of all, you want to take a look at that the pension option, the income option, if you will. And let's just say, I'm going to make this real simple. So let's just say it's $10,000 a year. So that's one variable. Then you look at, well, what's the lump sum option? Well, if it's $100,000, you divide the 10,000 to 100, that's a 10% payout. That's a really good payout, right? And then you got to look at, does this get adjusted for inflation or not? Probably most private companies don't have inflation adjustments. A lot of the government pensions do have inflation or cost of living. So that's obviously a factor. 10%, or maybe it's $8,000 of payments and it's a $100,000 lump sum. That's 8%. Might look good today.
Today, yeah. But
right?
So the problem with that calculation, I think you're on the right track, but you have to take the net present value of those future cash flows.
You do.
And then you take a look at what your life expectancy you think is. So you have longevity, you're going to live longer if you don't have longevity, right? And then so you say, all right, well, maybe I'm going to receive these payments for 10, 20 years.
Right.
And then you take the net present value of those cash flows, and then you compare that to the lump sum option. And then that's going to give you your best decision just on a pure dollar figure.
Sure.
But then you have to calculate taxes.
Yeah.
You have to calculate your family. So this individual, hey, I got a son, he's 32, still living with me.
Right.
Never went to college, he's got a very low paying job. What do I do here? Should I consider him?
Yeah.
Because if I take the pension, if I die, then it's gone.
That's exactly right.
If I have the lump sum, maybe then there's an inheritance for the child.
Yeah, exactly. And particularly if I'm 68 years old and I'm not in terribly good health, I probably would favor the lump sum, and I would think about my child, because that would certainly be a factor.
But this guy seems like he's got his act together in a sense, is that if he's 68, he's got a 401k, he's got a pension, he hasn't filed for Social Security yet. So that means he's got, either he's still working or potentially he's got other assets that he's drawing from.
Right. But that's yet another factor. Social Security is also a payment stream that would go away if he passed. So again, the answer is, should he consider son? The answer is yes. But there's a lot of variables to help you decide whether you ought to take that lump sum or not.
But I think he first has to consider himself.
Of course. But what would you say, Joe? I mean, because a lot of people have this quandary right in front of them. Would you say more people should take the pension, or more people should take the lump sum, or is that not? We really can't answer that.
There's
question.
no way you can answer that. There's no way.
Okay.
You have to take a look at all the different factors that we just looked at.
I just said most.
Right? Yeah. But I don't know if so I might have a little bit different opinion in regards to looking at the son.
Okay.
Right? I think a lot of times parents jeopardize their own financial security for their kids.
Yeah, I agree with that.
Right? And I understand that to some degree, but I don't have any children. You have children.
Yes.
Right? But it's like, I mean, we talked about this last week. I mean, you got these parents that are paying like $20,000, $30,000 a year for like extracurricular activities for their kids.
Right.
And they don't have a dime saved in a retirement account. Or they don't even have a cash reserve. But they're spending $30,000 a year so their kids can, they're not, funding college. So so they can play soccer.
Right.
I mean, I played kick the can. Right? Hide and go seek.
Yeah, and you turned out all right.
I did pretty good. Right? So it's not like, hey, Mom, I need new cleats and because I probably suck anyway.
Yes. So I agree with everything you said. And I would just add the caveat, because he said, should I consider my son? The answer is yes. But is that the main factor? Absolutely not. Everything that you said is true, Joe, because all of these the pension versus the lump sum, the 401k, the Social Security, these were benefits, retirement benefits designed for you, not your son.
Exactly.
Right. And you are right. And I would say that the baby boomer generation has probably gone a little bit overboard in trying to take care of their kids, and it really is now. It's affecting their own retirement. So I completely agree. But yeah, because you have a son that you're concerned about, yeah, I would definitely, that would be part of the equation, but that's not the main part for sure.
Here's another one. Why? Oh, this is interesting.
Okay.
Why should I hire a fiduciary advisor?
Oh, good.
There we go. So I'm eligible to retire now, but have a target date of 99 3 days from today. Oh, my goodness gracious. What the heck does that mean? I am currently a federal government worker under FERS.
Okay.
My brother says I should seek out a fiduciary advisor.
Okay.
How would a fiduciary help me? And at what cost? I am raising a preteen, still have a mortgage, and have a healthy TSP.
Okay. Good. I like that.
What do you think?
Well, what can now does it say? I don't know.
Just because he said I have a target date of 993 days from today means he needs to hire a fiduciary advisor.
In years, that's about that's a little under 3. Is that how government employees think about things?
I have no idea. Days and minutes.
It's on their calendar. Been tracking this. I was at 10,000 days. Now I'm 993.
I've been 993 days from my retirement.
Well, I will say this: a lot of government.
But he's like, my target date. Is that his target date fund? Or is that his target date of 993 days from today is when he's punching?
I think that's when he's punching. That's what I gather from that. I don't know if a 99.
Maybe you can, if you hire a fiduciary advisor, maybe you can cut that down to 992 days.
Maybe you can get a week early.
All right. Well, hey, we got to take a quick break. We're at the bottom of the hour here. We'll come back and we'll answer more of your questions. Go to purefinancial.com and we'll be back in just a second. Show's called Your Money, Your Wealth.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner alongside Big Al Clopine. He's a CPA. Thanks for tuning in. Pure Financial is the company that we work for. We're a fee-only registered investment advisor. Act as a fiduciary 100% of the time. We don't sell any products, just advice. And we're getting some interesting email questions here today, and so we're busting these things out. Investopedia, they send me stuff every week because they just love the answers. And I did get, full disclosure, I did get a pair of socks.
You did.
From Investopedia.
And you did mention that last time. I'm still waiting for my pair.
Yes. And so we're talking about this individual. He said, why should I hire a fiduciary advisor? I'm eligible to retire now,
okay.
he says.
All right.
But have a target date of 993 days from today.
Okay.
I am currently a federal government worker under FERS. My brother says I should seek out a fiduciary advisor. How would a fiduciary help me and what cost? I'm raising a preteen, still have a mortgage, and have a healthy TSP.
Got it. Well, I'm going to start this, Joe, by saying that I believe everybody needs a financial plan, but not everybody needs a financial planner.
Okay.
Okay.
Heard that before.
I'm going to start with that. But I will also follow that up with that almost everybody that I see, even the ones that say they have a plan, it's not very well thought out. So you actually might.
Or it's not executed.
Yeah, well, thought out or executed, right? And so you may actually want a second opinion or someone looking over this. And then there's a choice. Who do you go to? Do you go to like a full service broker that can sell you the insurance products that you need and other investments? Or you go to the fiduciary that just basically gives you advice? And we believe that you're better off going to the fiduciary because they're independent. They're fee only. They're not selling you product. And they're under a different standard, which is they have to give you the best advice, what they believe is the best course of action for you versus someone that's a broker that really can kind of sell you something that's suitable for you but may not be the absolute best investment for you. Now, so that's what I would say. I would say, yes, you probably should go to an advisor.
Right. I mean, because this guy
opinion.
definitely, or gal, is like, hey, man, I'm counting the days. I got 993 days. Get me out of here. So then you look at, all right, well, how can a fiduciary help you? Well, maybe you can cut those days down potentially. You got a preteen, you got a mortgage, but you have a healthy TSP. You're eligible to retire now. You're probably, 55? And so then it's like, okay, well, what's the goal here? You got a pension, potentially depending on what type of government worker you are. You might have some Social Security there too, right? So you got FERS, Social Security, you got your TSP. So now it's looking at, okay, well, on those three things, how are you going to create the retirement income that you need to make sure that you can retire? Can you retire a little bit earlier? Or do you have to wait 995 days? Or even more than that, 1,000, 1,900 days? So figuring this stuff out, then you can start counting different days to make sure that you know exactly what you need to do. And at what cost? Well, I don't know. It depends on the overall complexity. Our firm, we charge a couple $100 an hour, depending on what the complexity is and how much time it's going to take us to put together a full strategy for you. So it could take us 30 hours of work. It could take us 10 hours of work. It could take us 5. But when we do a financial strategy at our firm, and this is not meant to be a commercial, is that we have multiple facets when we look at someone's overall situation. It's just not a one-man shop. I mean, I'm thinking off the top of my head here, we have over, 30 CFPs, 25, something like that?
Yeah, I'd say, close to 30.
Right?
Probably.
So you could go to our website and count the certified financial planners on our team
to get the exact
number compliance. We have CPAs on staff. We have MBAs. Right? We have chartered financial analysts. So we have different departments, and we utilize each of those different departments. So it's not like a one-man shop and you're using one man's brain or one gal's brain. So we dive in deep into all different areas of someone's financial life to make sure that they get the best information and advice possible when it comes to Social Security strategies. Of course, taxes. We lean heavily there because we believe if you can save money in taxes, your money's going to grow that much further and you can take less risk. Then we dive into the overall portfolio, risk management, estate planning, and everything else in between. So with our firm, it's not like, here, let's just look at cash flows and say, all right, well, here's where you're at, here's where you need to be, and maybe I think you're on track. Well, sure. I mean, anyone, you could do that online. You don't necessarily need to hire an advisor, but if you really want to dive in, I think a fiduciary, certified financial planner, CPA type team is the best way to go. And of course, I'm biased because I'm a certified financial planner and Al's a CPA.
So that was very well said.
So anyway.
Check. And I think it was compliant.
All right. So, all right, let's go to, we got time for a couple more here?
Yeah, we do.
All right. Hey, are high yield bonds a good investment?
Oh, boy. Do we have more, or is that the question?
That's the question. That's all I got.
That's all you got.
Do you want me to take a stab at this, or you want to go with it?
I'm going to say no. And the reason is because a high-yield bond, another name for that, Joe, is a junk bond. In other words, it's a bond that has a high interest rate, but the corollary to that is there's a lot of risk. There's something wrong, or it's not rated as well as maybe an investment-grade bond, so you have more chance of default in something like that. So there's more risk. And number 2 is those high-yield bonds, as a general matter of course, tend to be more correlated to the stock market than other types of bonds. So in other words, when the stock market goes down, so do high-yield bonds. They tend to go down at the same time. They act a little bit more like equities in down markets, whereas high-quality bonds, yes, you don't get as much interest, but they tend to hold their value, and in some cases even increase in value when the stock market's going down. So no, I don't particularly care for high-yield bonds right now.
I don't think it's a good or bad investment. I mean, I think all investments have different characteristics, and I think you said that pretty well. Is that I think people get confused too, because I like high yields, of course.
Why would
I want a high yield bond? You just have to take a look at the risk factors of whatever investment that you're trying to get into. And so, if I want a really high octane, bond portfolio to give me the highest rate of return, you would go really long. So I would give my money to a really bad company for 40 years. Right, and hopefully I get that loan back.
And you get the highest rate.
You get the highest rate, right? So but Greece bonds.
Yeah, would it continue, and would you get your money back?
Exactly. So if this company is, hey, it's not rated pretty well, so that means it's low credit quality, and you're going to give them a loan. Right? You're not buying into the company. You're not taking advantages of profits if they turn this thing around. It is a loan. So bonds and stocks work differently. So I like to invest in companies that, are more value, lower priced. That's a stock. I'm buying into the future profitability of that overall organization. A bond is a loan. So if I'm looking at high yield bonds, so I'm going to give a loan to a company that has poor credit quality for a very long period of time, that will give me the highest yield. But that highest yield is going to, in comparison to a stock, I don't think the risk is worth it.
Yeah, I would agree. And then, Joe, there's the matter of taxes, because a high-yield bond is going to be ordinary income, and you got to pay ordinary income taxes at the highest rate. Let's think about a stock as a comparison. With a stock, you get a dividend, which is basically your share of the profit that the company is distributing out to you. And in most cases, if it's a domestic company or a foreign company on a domestic exchange, it's what's called a qualified dividend. And a qualified dividend is taxed at the capital gain rate, not the regular ordinary income rate. It's the capital gain rate, which is quite a bit lower. Now, furthermore, with a stock, when you buy and then later sell, if you hold the stock for a year and a day and sell it at a gain, you pay capital gains rate on that too. Now, your bonds, well, that's ordinary income, and high yield is going to be taxed at the highest of rates. And if you think about this, if you got a whole bunch of money in an IRA and a 401k with your required distributions, that's going to be at ordinary income.
Right.
Now you got your high yield bonds outside in your non-retirement accounts. You're paying ordinary income. You got Social Security. You got maybe a pension. You got all kinds of stuff, and it's so it's not very tax efficient. And we talk a lot about tax efficiency because a lot of people don't realize they have much control over their taxes, but it's not true. In retirement, you've got more control over your taxes than any other time in your life. And a lot of advisors aren't really talking about that because they're focused on investments or they're focused on taxes for the current year. But you got to have a forward-looking tax strategy to be able to pay the least amount of taxes over your lifetime.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner. Big Al Clopine sitting next to me. He's a CPA. And we're getting into your questions here today. Got some emails from Investopedia. Got some emails from NerdWallet. Don't think we're going to get to NerdWallet.
We've had such a good time with Investopedia.
Oh, man.
Except we're not laughing as much today.
Well, because some of these are actually pretty good questions.
I suppose. Maybe.
Sometimes we get a bag of questions that it's like you got to wonder who was on the other side of the computer. I'm telling you.
Yes, good point.
All right, well, man, we're at the last segment, home stretch. Thanks for hanging out with us. Go to purefinancial.com. Go to subscribe if you'd like to our podcast, iTunes, Your Money, Your Wealth. A lot of podcast listeners out there nowadays. iTunes, Your Money, Your Wealth. Or you can, whatever, I don't know how else you get to our podcast, but I think we're on every single thing.
Just all the things.
Yes, all those different gadgets.
Well, I have the podcast app on my phone, so you can get it through there too. Your Money, Your Wealth.
Yeah, but there's like Fireburner and...
I know, there's all... Yeah, I mean, I don't know, but...
We're on those too.
I'm sure, because we're solid.
We are. We're not.
Our people are.
Yes, our clutch marketing team.
Yes.
Like Mike and Megan.
Yes.
So Mike is listening to this, and so she's got to type all this stuff out and send it to Investopedia.
She does, yeah.
She does a great job at it.
Yeah, Mike.
Just wanted to say thank you,
I just can't believe how good a job you do. And,
oh my God.
And you...
All right, here's the next question. Do I need to pay capital gains tax on the sale of my retail space? All right.
Okay.
I am being bought out of my second business by the landlord who needs the retail space back for $730,000. What at the capital gains tax implications on this sale? Currently, I have another 10-month-old business that I borrowed and spent $850K to open.
Okay.
All right, so he's selling this, and so there's not nearly enough information. But I guess thank you for telling us it's your second business.
That was helpful.
By the landlord. So you might need a new landlord if he keeps buying your businesses out.
Maybe that's a good thing.
Who needs the retail space back for $730,000. So do you own it? I don't know. What is the capital gains tax? It could be nothing. It could be zero. Do you own the... Or are you receiving $730,000 of capital gain?
Yeah, we'll make some assumptions here, first of all. I think in one sentence he said, I'm actually selling the business.
So let's just say he's got a capital gain of $730,000. But if he's selling a business, there could be ordinary income in there, too.
Well, it depends how it's being sold. So
exactly.
let's go down that path just for a second. So let's, first of all, he's selling it for $730,000. Let's just say he invested... I don't know. He invested $230,000 in this business, so it's a $500,000 gain. So when you look at gains, you always look at what you're selling something for versus what you paid for it in the first place. And in the business, it's what you paid for common stock, what your basis is in the business. So in this case, I'm just making this up, Joe. Sell it for $730,000. You got a tax basis of $230,000. You got a $500,000 gain. It is capital gain if that's what you sold. And you pay, some of it will be probably taxed at 15%. Some might be taxed at 20% federal tax. There is no Medicare surtax at 3.8% when it's your own active business, so you avoid that. You got state taxes. Now, if you sold this business in such a way that maybe, let's say the business sold for $400,000 and you got a $300,000 consulting agreement. In other words, you're going to stay involved in this business, so you still sold it for $730,000. But now the capital gain part is $400,000 sales price minus the tax basis. Let's just call it $200,000. You got a $200,000 gain, and the $300,000 that you'll receive for your consulting services, well, that's ordinary income to you. So it could be that.
Right. Okay. So let's just look at this. $730,000 gain, but he borrowed and spent $850,000 to open another business.
Yeah, so if he sold business one and then later opened business two, they're completely unrelated.
But he's thinking, hey, I borrowed $850,000, so does that $850,000 offset the $730,000?
No.
I guess that's what he's really asking here.
Yeah, I think that's what he's asking too. So can you no, unless if you sell both businesses.
And you got one loss.
Yeah, so let's say you sold both businesses for $700,000 and you put $850,000 in, you got a $150,000 loss, right? So that.
But he put $850,000 into the business. He doesn't sell it. What can he write off?
It depends what it was spent for. So let's say it was spent for equipment, then he can depreciate that equipment over 5 years, 7 years. He could take the Section 179 write-off for $500,000 if he's got income from that business. So that's a caveat there. You got to have income to use the Section 179. If he used it to pay employees, well, that's deductible. If he used it to buy inventory, it's not deductible until he actually sells the inventory. So it depends. So I think we exhausted that.
Ugh, too much. All right. Got a couple minutes to go here.
Okay.
Which income option is best for a 70-year-old?
Okay, 70-year-old.
All right. I am 70 years old and don't know which income option is best for me.
Okay.
I have a presidential annuity and have named my husband as a beneficiary. I do not understand the difference between life annuity with guaranteed monthly payments, and joint and survivor annuity.
Okay.
Well, I'm going to bust this out, and then we're going to get out of here.
Yeah, this sounds like a question for you.
All right, the difference between life annuity, that's just on one life. So if you pick a life annuity, you're going to annuitize that contract, it sounds like, and then it's just on your life. So you're 70 years old. They'll take a look at, all right, well, how much is in the contract? You're 70. We're going to give you X amount of dollars for the rest of your life. Now, if you die the next day, then that dollar's gone.
So single life.
Single life. It's going to give you the highest income benefit for sure because it's just on one life.
Right.
So if you think, hey, I'm in a lot better shape, I'm a lot better health than my husband, I'm going to live a lot longer, and he's got plenty of money. If I die, he doesn't need this income. Well, then you might want to go the life annuity, but you want to make sure that you check all your options and everything else, because what that's going to do to the spouse or surviving spouse if you were to pass away. So single life, that is just life annuity, that's you. Life annuity with a guaranteed monthly payment. So let's say, hey, I want the life annuity, but I want a 10-year guaranteed certain. So what that means is that, all right, well, here, I'm going to have a higher benefit than a joint life. And then let's say if I die the next year, what's going to happen is that payment will still be guaranteed for the next 9 years if you selected, let's say, a 10-year period certain, 5-year period certain, or whatever it is. So that period certain is that if you die prior to the period certain, that payment is still going to pay out to the family or the estate, if you will, for that time period.
Got it.
So if you want to protect it for a certain time period and still want to get a little bit higher benefit, then that's the option. A joint with survivor annuity, that's going to give your spouse the same annuity payment as you if you were to pass away prematurely. So that payment continues to go on for both lives. So I take a joint life, I get that income, and then if I pass away, then my spouse would continue to get that same income until my spouse dies. So those are the options. So I understand it's confusing. All this stuff can be very confusing. So you have to look at so many different options. You can't look at this stuff in a bubble, because then you'll probably make big mistakes and say, hey, I want the single life annuity because that's going to give me the biggest payment. But then guess what? You might be hurting, your surviving spouse. I mean, anyone who's recently retired or looking at retiring in the next few years, has really 3 significant challenges facing them today. Truth be known, right? You probably haven't saved nearly enough for retirement, and you don't have enough to last you for the next 25, 30, or even 40 years. So you better get serious about saving now. You have no retirement game plan. Right now, your plan is nothing more than a bunch of scattered statements. There's no plan or strategy surrounding healthcare, taxes, Social Security, or how all your investments are going to work together. And if you're truly honest with yourself, you probably have a lot more questions than you have answers. And finally, 99% of what you know about retirement, it's dead. It's equivalent to like an 8-track tape player. You need new solutions that are going to stand up to today's challenges, like record low interest rates, increasing longevity, skyrocketing healthcare and medical expenses, unprecedented stock market volatility in a country with close to $20 trillion in debt? Do you want me to keep going here? You can no longer rely on a company pension plan or a government for your retirement. You're truly on your own.